topics they presented. So Professor Fama touched on his research and how we at Dimensional got started in systematic, or what's often known as factor fixed income investing, back in 1983. We now manage about $120 billion in global fixed income, which is a great outcome of our performance in managing these strategies, as well as the trust that clients have placed in our capability. So turning to Joel Kim, you used to manage fixed income strategies using fundamental approaches in your prior roles, which of course most investors in our audience are quite familiar with fundamental fixed income investing. Now, as the head of international fixed income at Dimensional, you've been managing fixed income in a more rules-based, systematic way. So to start off with, can you describe what is systematic fixed income and why have we seen so much interest from investors?
Yeah, thank you, Abi. Let's actually start with your second question, the increased interest that we see in systematic approaches. There's probably various reasons for this. To some extent, it's asset owners diversifying away from these traditional active approaches, looking for alternative alpha sources. What has definitely been taking place is the search for lower cost alternatives, especially in the current low yield environment. And that has led to increased demand for passive, but definitely also for systematic factor or like smart beta solutions. And that has coincided with a general trend of like the asset management industry as a whole, applying technology and data in a more systematic manner. Systematic managers like ourselves, who have done that for decades, tend to be especially well positioned in that environment. So let me move on to that first question that you have. And over the next 30 minutes, Wei and I will unpack some of the things that were mentioned in the interview with Professor Fama. To your question, what is factor investing? And apologies to those on the call that are very familiar with the topic, but some of you are new or less familiar with it, including the terminology. So in addition to that, factor investing is typically better known in the equity space and less so for fixed income. Many definitions for factor investing, but a good one in our view would be that systematic investing typically seeks to outperform the market through a rules-based approach where you structure investments around factors linked to differences in expected returns. Now, that's a whole mouthful, but in a practical sense, you can think of this when you manage a portfolio this way, that you rank order the universe of securities on factors and apply factor tilts in a portfolio to capture the premiums associated with them. So clearly identifying factors is part of the challenge. So let's address the research underpinning our approach, and let's start with forward rates. Now, in the interview, was frequently referred to like forward rates. Professor Fama wrote a number of classic papers on the term structure of interest rates in the 70s and 80s. A way I think it's fair to say that his findings are still very influential to what we do.
Yes, absolutely. And you're right that the term structure literature has a very long history. And empirically, academics have been trying to look at the informational content in yield curves for at least 40, 50 years. And as Professor Fama was explaining in his interview, much of that earlier empirical research, including his own, was concerned with two related questions. One, do forward rates predict future interest rates, right? So basically testing different versions of the expectation hypothesis. And second, what do forward rates contain information about expected returns of bonds across different maturities? And one important conclusions from those papers, including the seminal papers that was mentioned in the interview by Professor Fama and others, basically what they find is that forward rates are poor predictors of future spot rates. Instead, they contain a lot of information about term premiums. Or in other words, if you look at forward curves today, what that tells you is the term structure of expected returns. So what that means to us is that we can use forward rates as a signal, as a factor to systematically identify fixed income securities with high expected returns and to capture the higher term premium. And this finding is first, documented at the lower end of the yield curve by using treasury bills, and then also extended to longer maturity bonds and also confirmed out of sample. And the same idea also applied to credit and in a global setting. So when we think about forward rates, they vary across bonds, right? Based on their duration, their credit quality, and their currency of issuance. So essentially, we can use that information to adjust our term, credit, and currency exposure, basically along those dimensions.
Yeah, thank you, Wei. So moving on from forwards and the early work that was done by Professor Fama, it's fair to say that there's a lot of recent research done on alternative factors in fixed income, both by academics as well as market practitioners, and definitely for credit. Much of it tends to follow what people are familiar with in the equity space, so factors that roll up to value or quality, defensive, momentum. There's by now so many identified that it starts to resemble what you see in the equity space, a whole factor zoo. In the meantime, we at Dimensional haven't stopped doing our own research. So maybe you can share some thoughts on this, including what we are doing.
Yeah, absolutely. I think, as you're pointing out, systematic fixed income is a very active and evolving area of research. And a part of our job as researchers is to keep abreast of the stuff out there and also sift through the research and conduct our own research to get an idea of which variables are actually useful out of that factor zoo, as you were referring to. And I think earlier in the interview, Professor Fama said that he hasn't seen anything really compelling, at least to not compelling enough to replace the role of forward rates as a predictor of bond returns. I think that really reflects the high standard that he sets for what he considered as robust research. And there's certainly some truth to that. Because on our end, we are constantly looking for ways to enhance our portfolios, enhance our approach, and looking for new signals we can add into our investment process. But we also find is that a lot of the variables do not really stand up to closer scrutiny. And so just to give our audience a sense of the kind of the scope of our research, here is a partial list of the things that we have looked at. Understanding whether there's information about expected returns or risks containing these variables. So you can see that from left, you see on the left-hand side some bond level characteristics or variables. So things like yields, forward rates, we talked about a lot, as well credit spread, default adjusted credit spread, and also some return-based variables like bond momentum, credit momentum. And then there's also a lot of issuer level characteristics. So basically pertaining to the companies that are issuing those debt. And I think that's what, Joe, you were referring to. A lot of the factors that were successful in the equity space are kind of copied over here. So you're looking at things like market capitalization, price to book, profitability. Those are the factors that have been used successfully in equities. And of course, many other variables like leverage and also, equity, short-term equity returns and momentum and so on. And you also see some of the non-traditional factors, for example, ESG, thinking about greenhouse gas emissions. So these are all the things we're interested in because ultimately we want to find variables that can tell us more about expected returns and can help us enhance our portfolios. Now the big question is, well, how well do these variables fare in terms of their prediction of future returns, right? Future bond returns in the cross-section. And one way to do that is to kind of sort bonds into different portfolios based on these variables and see if these variables do generate a return spread. So that's essentially what we're trying to do on the next slide. I know that this is a slide with lots of numbers, so just to orient ourselves a little bit. So you see lots of rows, so each row represents one variable. And in each row, what we are trying to do is to sort at the end of each month, all the bonds in the cross-section based on one of these variables from low to high. And then we look at their subsequent returns in each of those portfolios. And then we do that every month and we look at those average monthly returns. So for example, if you look at the first row, we're sorting bonds based on their forward rates in their 4 quartile portfolios. The lowest, so the lowest 25% by market cap. So they are in the low portfolio. These are the bonds with the lowest forward rates. And then you move on to the second quartile, the third quartile, and then to the highest portfolio. So that's the bonds with the highest forward rates at the end of last month. And then you look at whether, right, you see returns monotonically increasing based on your sorting variable. And you see that's the case, right? The lowest quartile gives you 31 basis points in terms of average monthly returns. And the highest quartile gives you 67 basis points. And then in the last 2 columns, you can see that if you look at the return difference between high versus low quartile, you're looking at a healthy return spread of 36 basis points per month. And that return spread is reliable, as indicated by the t-stat of above 2. But if you look across the rows, many of those variables do not generate the same kind of return spread. Many of these return spreads are pretty small, so economically not very meaningful. And also many of those spreads are not reliable, so as indicated by their fairly small t-stats.
Yeah, great. Thanks, Wei. So again, to your point, if you look at a couple of ones that are typically used elsewhere, like profitability or leverage, those clearly don't meet the criteria. They're not robust. If you look at across the quartile portfolios, there's no monotonic pattern, no significant return spreads, and it doesn't seem to be reliable either. So clearly, well, we do the research that some of the very popular factors that people consider right now, yeah, simply don't pass the test in our case. Now, we use forward rates as the main factor, but there's a couple of other ones that do come out with numbers that seem to look okay. So for example, the second one, default adjusted credit spreads. Maybe quick description of what that is. So it's a very popular value metric where you basically rank order credits on the credit spread and where you basically anchor them to a risk metric. In quite a few cases, that could be a model output, so something like a distance to default, for example. Is that correct?
Yeah, that's absolutely right. And in that context, you can actually think about forward rates as a value metric as well, right? Because ultimately you're looking for bonds with higher yield, bigger roll down. So that's essentially a form of value investing. And as you said, Joel, the default adjusted credit spread can be another metric for value. And then I guess the other thing I will mention is that there are lots of terminologies out there. So early on, you mentioned like defensive, quality. These are often composite measures, right, that are related to some of the metrics we're using here. So thinking about maybe they're using a combination of term and credit quality and leverage. So there you just need to be even more careful when interpreting the results, because once you have lots of variables rolled up into one composite, then you're subject to even more kind of additional selection and overfitting bias. And if you're not seeing anything in the underlying variables, you should be extra careful. But I think going back to your focus on the credit, default adjusted credit spread, yes, on a standalone basis, you do see that it is generating a healthy return spread. So the question is, is that variable telling you more additional information about expected return above and beyond the forward rates that we already know and already use? And that's what we're trying to do on the next slide. So exactly the same setup, same variables, but on the next slide, what we're showing, instead of the total returns of these monthly of these portfolios, we're showing the total returns in excess of forward rates. So essentially, because we know that forward rate is already a good proxy for expected returns, you want to know whether these variables tell you something incremental about the unexplained part that's by forward rates. And there you can see in the second row that the default adjusted credit spread already loses its power. So meaning that although on the standalone basis, the default adjusted credit spread gives you a reliable return spread, but its explanatory power for bond returns is subsumed by forward rates. In other words, if you already have an investment process that uses forward rate, then adding this alternative metric for value is not going to improve your investment outcomes.
So how about short-term equity returns? That's another one where the numbers look okay.
Yeah, you're certainly paying a lot of attention to the tables, and you're right. If you look at second to last row, you see that short-term equity return is an example where on the standalone basis it generates a return spread, and also after controlling for rate, it still appears to work. Essentially, what that says is that if you look at the stock of the issuer of the bonds, if the stock kind of underperformed their peers on the performing market over the recent, say, 1 month, then subsequently their bonds tend to also underperform their peers. Earlier was talked about how forward rates can be a value metric, right? Can be thought of as a form of value investing. Then this short-term equity return signal, in my mind, then is a form of trying to avoid some of the value traps. Now, it's useful, but I think it's important to understand a little bit better the behavior of this variable, which then have important implications for implementation. So on the next slide, what we're trying to look at is, what's the potential, turnover and cost associated with chasing these variables. Now, what we're trying to do still, each bar still shows that the high versus low quartile portfolio return spread, like what we looked at earlier in those columns. But instead of rebalancing monthly, now we're rebalancing, gradually reducing the rebalancing frequency, say to semi-annual or annual rebalancing frequency. On the left part of the chart, you see that for forward rates, the return spread is still pretty strong and not really affected too much by reducing the rebalancing frequency. But on the right, for short-term equity return as a signal, you see very different picture, right? On the monthly basis, if you rebalance monthly, then you see a reliable return spread. But as soon as you do semi-annual, then the return spread is no longer reliable. And if you reduce even further, it becomes negative. So this is another way of saying that in order to capture the premiums associated with the short-term equity return, if you were to chase it, you have to incur a lot of turnover and potential cost, which can actually erode the premiums you're seeing on paper. So in our mind, because these variables behave differently, the information decays much faster in the short-term equity return signal. Instead of just combining these variables and then treat them the same way, we think a much better way is to kind of structure and manage your portfolios around forward rates, and then use short-term equity return in your daily process as part of the credit monitoring or trading process, as a way of kind of screening your candidate orders. We think that way you're getting the kind of the premiums, but without incurring additional turnover and costs. I will probably end by saying that this is a very good example of showing that not every signal is a quote unquote factor. You really need to think very carefully about where you want to use each factor, each signal, and how you want to use it. Because at the end of the day, what's on the paper may not be translated into real world portfolios.
Yeah, thanks, Wei. Exactly to your point. Factors and selecting and identifying factors are important, but by themselves, they don't constitute an investment strategy. And that was exactly what Professor Fama was referring to. It's at the end of the day, your ability to actually capture the premiums in a real portfolio. So the factors may exist on paper, but you got to factor in potential transaction or other friction costs, and hence the daily process required to use the information as efficiently as possible without incurring, to your point, the necessary turnover and minimize the transaction costs. That's very important. And so one of the reasons why you see that wide dispersion even across factor managers is partially in terms of investment performance, is partially due to the factors used, but also because they tend to implement differently. And from that perspective, experience and actually having it done in real, what is the track record of a systematic manager is very important. Now to switch gears and to now think a little bit more about how do factor approaches work in real life, and let's link them into some of the current events that came up in the interview with Professor Fama. So undoubtedly, there's been a lot of focus on inflation, central bank policies, and what then the impact is on fixed income markets. What was quite clear from the interviewers is that Fama is quite skeptical about a couple of things. So, Wei, can you perhaps elaborate on this and talk about some of the analysis that we've done?
Yes, absolutely. Because I think these questions are certainly on top of mind for many investors, and then based on our experience talking to clients as well. Maybe I'll start with Fama's comments. I think skeptical is probably the right word describing his view about the Fed's ability to control interest rates, and that view is informed by his own research. In fact, in 2013, he wrote a paper showing that while the Fed can set Fed funds target rate, any effect of that Fed fund target rate on, say, other rates really dissipate very quickly over longer maturities. And in the end, it's just really not clear in terms of the Fed's role versus the market force in setting the long-term path of interest rates. So I think that's kind of basically what he was trying to explain in their interview. Now, from our perspective, while we certainly don't want to discount the important role that Fed and central banks play in the global financial markets, but it is a helpful reminder, I would say, that central banks and the Fed, they don't act in a vacuum. At the end of the day, they are one of the many market participants in this larger ecosystem. So then when you think about broader yield curves, interest rates across the yield curves and globally, we think that they contain the aggregate expectations of market participants. So that would include expectations about future inflation, include expectations about what the Fed will do, when and by how much they might raise interest rate, what they plan to do in terms of QE tapering, so on and so forth. And then consistent with that view, what our research shows is that you actually don't see a very consistent or systematic relation between, say, the target, the Fed fund target rate and bond returns or term premiums. So in other words, the Fed raising interest rate doesn't necessarily mean that you should just go to cash or that you should reduce your duration exposure. Now, of course, we say, a lot of things are priced in, the expectations are priced in, but in the end, the realized future inflation may be higher or lower than what's expected. And the Fed's actions may be more aggressive or maybe less aggressive than expected. So that's why there's always a lot of debates, right, in the media, among practitioners. There's always a lot of stories around those. But we think that the unexpected components cannot be consistently predicted. So in our mind, rather than trying to outguess what market is trying to say, we think a more robust approach is to try to position our portfolios based on the information that's priced into current yield curves. And I would say that philosophy and approach have served us pretty well over the last 40 years across many different market conditions and economic environments.
Yeah, thanks, Wei. And I guess related to that, yield curve shape and even inverted yield curves came up. Well, most recently, yield curves have been flattening significantly. We're getting quite close to the point where at least some of the yield curves we're only like 20 basis points away at certain yield curves. So that's obviously on the back of, on the one hand, expectations of higher policy rates pushing up short-term yields, but the outcome for long-term yields, as was mentioned in the interview as well, like clouded in noise, given many factors impacting the back end of yield curves. Most recently on the back of geopolitical events with the potential for lower growth, but perhaps more inflation. So it makes the whole situation even trickier, and it highlights the difficulty of consistently being right on your forecast there. In Dimensional's approach, the shape of the yield curve certainly matters, but rather than making directional bets and forecasts, we associate these flatter yield curves with less probability of harvesting term premiums going forward, and hence the implication for duration positioning in an environment like this, as yield curves flatten, is that we gradually roll back, shorten the duration in a portfolio. We would do the opposite if yield curves steepen. So moving on from that, another aspect of implementation is managing risk, not unimportant. And let's focus on credit. Financial markets have been very volatile recently. Equity markets, credit spreads have been widening the last couple of weeks. We saw even more of that, obviously, a couple of years ago at the emergence of COVID. So how does that work in a systematic approach? So what should be clear by now is that we don't rely on traditional credit analysis, forecasts associated with that. But as what Wei showed earlier, even if you want to do this in a systematic way, there's also little to no relationship when we look at some of these fundamental variables, defensive quality, data around like profitability or leverage. So what do you do then instead? So what we do know is that wider credit spreads today tend to be predictive of higher credit premiums in the future. Typically, investors want to be rewarded for increased uncertainty, definitely happening right now, and they want to get that in the form of a premium. But at the same time, from a portfolio management perspective, we want to avoid potential value traps by blindly buying anything with a very wide credit spread. So to manage this sort of firm-specific idiosyncratic risk, we use information in prices, market data, rather than fundamental data. And that has the advantage of both providing real-time information about credit quality, as well as you avoid, potentially working with still data. Now, we've got a whole research paper on that particular topic, real-time credit monitoring, and Wei happens to be one of the co-authors of that paper, if I'm correct. So we don't have time to go into detail on that. I just want to highlight the actual outcomes. So we've been applying this over the last 10 years or so. And so what you see in this table is when you look at, for example, the top half, like all internal downgrades that were applied by ourselves over the last 10 years, then in 64% of the cases of these internal downgrades, they were driven by our methodology. And in the residual, the 36 other percent of like the other cases, Moody's or S&P were ahead of like the signals that we get our methodology. So 64% we were ahead of like the official rating agencies, 36% we trailed. When we look at a very challenging year like 2020, that percentage of like internal downgrades that were driven by prices, by what we do, actually went up to 79%. And then if we go to the bottom half where we zone in on so-called fallen angels, so investment grade issuers that get downgraded to below investment grade, to high yield, and you see across the full 10 years, including 2020, that percentage driven by what we do is actually very high. So I guess that illustrates that using market data alongside the information that we get from credit rating agencies provides us a more complete real-time picture of an issuer's credit quality. Now, that gets us closer to the end. I know that this was a lot of information to squeeze in 30 minutes after the interview, but hopefully you have a slightly better idea about how factor investing in fixed income works, at least at dimensional. Also what to look out for when you evaluate both research as well as implementation in systematic approaches, and how that links into some of the topics that were discussed with Professor Fama. So we have been running systematic fixed income strategies for 38 years at Dimensional. As Abi already mentioned, we're currently managing about $120 billion of fixed income assets. If you're interested in how that has performed, please contact our regional directors, the people from our clients group. We also recognize that fixed income needs can be very diverse and specific. So our approach definitely lends itself well for customization to make sure that we meet those needs, including, for example, ESG. All right, since that was a lot to absorb, my colleagues will actually distribute a number of papers on the topics that we talked about. They can also follow up with you in more detail on particular questions that you may have. Apologies, we don't really have time for that right now to address those. In the meantime, I want to thank you for listening to us, and I'm going to hand it back to Abby.
Thank you. Yes. So we're actually finished with the webinar. Many thanks to everyone for attending as well. And as Joel mentioned, we will follow up with everyone that attended and answer any questions you may have as well. Thanks, everyone, and have a great day ahead.